Right guys, so this transaction is the issue of ordinary shares, which is what we'll be looking at next. And if you have a look here, sorry about that, Victory Limited registered with an authorized share capital of 1.5 million shares. A prospectus was issued, and on the 1st of July 2013, which is the first day of the year, 900,000 ordinary shares were issued to the public at an issue price of 4.50. Good. The year end is 30 June 2014. Two things to take note of here. Number one is the authorized share capital of 1.5 million. That is how many shares Victory Limited is actually allowed to issue to the public. So that's the level that they can go up to. And here they've issued, actually, the transaction happening here is 900,000 shares issued. So this is a way for them to obtain capital. This is a financing activity, and they're going to get funding, not from a loan, but by the issue of shares because they're a company. So let's look at how to record this transaction. But before we do that, let's quickly calculate the amount of the shares that was issued. So we have 900,000 shares that were issued, right? So at a price of 4.50. So we're simply going to take the number of shares and we're going to multiply that by the price per share. And if I show you here my formula bar, you can see that the formula is 900,000 times 4.50. That's going to give me a total amount of just over 4 million issued share capital that this company can raise with the issue of shares to different shareholders. So now different shareholders have got a stake in this company, and the company has obtained financing to the value of just over 4 million rand, so they can go and execute their business plan. Right. Now, whenever we have a transaction in accounting, we need to determine the two accounts affected, because there's always a give and a take. So let's see, what's the two accounts affected here. Well, number one, we need to ask ourselves, what is the two accounts affected? So let's see. Well, we issued shares, so we know that shares is going to be one of the accounts, and we call that account ordinary share capital. With the new syllabus, there is no more share premium as in the past. We have the total amount of the share price, which is going to go to ordinary share capital. That's a change in the legislation, a change in the Companies Act. Right, so that's the one account affected. And then you know that the company obtained financing, so they got money. So the other account affected is my bank account. So let's put down my bank account here. So the next question that we need to ask is, what type of accounts are these? Ordinary share capital, that's an equity account, all right, because it represents money that is owed to the owners of the business. Okay, so that's an equity account. Bank, you should by now know, is an asset that belongs to the entity. Right, so the last question that we need to ask is, was this an increase or a decrease in these accounts? We issued more shares, so that is clearly going to be an increase. What happened to my bank? Was that an increase or a decrease? We got more money through the issue of shares. This company actually obtained financing, so that's also an increase. Now that we have our information, we can go and determine whether we need to process a debit or a credit by using our dead click rule. Right, so the dead click rule, just to recap, means debit, expenses, assets, and drawings. Credit, liabilities, incomes, and capital. So I'm just going to do that, debit, credit. Right, so the first one here, equity. What is this? Which one of these? Is it EADLIC? It's going to be the C. The equity, the ordinary share capital, is the same as my C in my dead click abbreviation. So I've got capital that increased. What does dead click say? Remember, dead click is for increases. Very important, for increases. If it's a decrease, then my debit and credit here will swap around. All right, so I've got equity, which is the same as my C. That increased, that's going to be a credit. So I can process my credit for equity. These rules you should know off by heart by now. And at any time I wake you up, you should know whether an asset increases or decreases on the debit or credit side. Right, then we've got an asset that increased, and you should already know, well, if that was a credit, this is going to be a debit. But just to double check, debit expenses, assets, and drawings for increases. So this is correct. This is going to be a debit. Perfect. So we can go back to our information, and now we can process this in our subsidiary journal. So which journal is going to be affected with this transaction? We issued shares, we obtained financing, we obtained cash. So my cash journals are affected. And the specific one affected here is the cash receipts journal. Right, we didn't give out any money, we received money. So this is the cash receipts journal of Victory Limited. And it's for the month of July 2013. You can fill in the document number that wasn't given. So I just use the generic one there, receipt 1. The day is the 1st of July, so we can fill that in. The details here, you always need to put the third party or the other party with whom you transacted. So here it will be the shareholders. Sorry about that. The shareholders or the financial institution that managed the issue of these shares. Right, so we're just going to put that in there for now. And then finally, we need to put in the amount of the shares that we issued, the issue price times the number of the shares, which came to 4.050 million. All right, and we put that again. We're going to put that in the sundry accounts column because it's not going to be an account for ordinary share capital. Okay, so my one account affected is bank. There we go. My one account affected is bank. The other account is going to be ordinary share capital. And we're going to put that in the sundry accounts column, and we're going to write here ordinary share capital. After we've done the journal, the next part in the accounting cycle is to post the journal, which is like a diary of all the entries that takes place during the month, and to take this journal and to post it to the general ledger. All right, so which two accounts are affected here? Well, we know the one is bank and the other one is ordinary share capital. Ordinary share capital is equity, that's why it increases on that side. Bank is an asset, that's why it increases on the debit side. Right, I'm also going to use this legend throughout. All right, so assets will be colored green, equity will be colored blue, liabilities red, incomes will be blue with the blue font, and expenses will be blue with the red font to distinguish them. Right, so let's just color our bank, and we're going to make that green. And my ordinary share capital, we're going to make that our blue. There we go. So now, where do I need to put the amount? We've already determined the amount of 4.05 million. Does that need to go on the debit or credit side of bank? Well, we know our bank increased, and we already determined the debit here. So we're going to put the 4.05 on the debit side of my bank. There we go. And the credit, remember, every debit must have a credit. That's the first rule of accounting. And that's going to go on the credit side. Right, so there's my debit and my credit. Now the next step is just to complete the details. We're going to fill in the date on the 1st of July 2014. So we can fill that in here, 2014. And we can fill in the date here, 2014. All right. And then we need to put our journal as well. And in this case, we recorded it in the cash receipts journal. So this is what they call posting. Now we got this amount from the cash receipts journal. So we're going to go to my cash receipts journal, and I'm going to put here a folio reference of B. What is this? Let's go back. Well, we haven't given one to bank yet. Let's make bank B2. All right, there we go. Bank is going to be B2, and ordinary share capital, we're going to call that B1. So this 4.05 we got from the bank column here. So we can post that to the bank, B2. There we go. You'll normally post the total of the bank account, but in this case, there's just one transaction. So I'm just leaving it at that. And then here we're going to refer to B1. There we go. So there I have posted this transaction to the ordinary share capital account, and I can refer here back to my cash receipts journal. Transaction successfully posted to the ledger. All right, then I need to complete just the details in my ledger. Remember, the details can never be the same as the name of the account. it should always refer to the other account, the other leg. We call that the contra account in accounting. So the details I need to put in here is going to refer to ordinary share capital. And I'm going to color that blue so you can see that it refers to the other account. And the details I'm going to put in here is going to be bank. So I'm going to color that green so you can see it's an asset. Good, so journal done, general ledger done. We're not going to use the general journal because we've already recorded it in the cash journals. And then finally, we're going to show the effect on the balance sheet. So what happened here? The company obtained financing, specifically cash. Right, that is the asset that the business got. They got cash to the value of just over 4 million. So we're going to include that in our cash and cash equivalents. So we say calculation 1, and you can see my current assets increase and my total assets increase. All right, but there always needs to be two sides to the transaction. So the other leg is going to go to my equity. All right, because I issued some shares and my share capital has increased and I now owe more money to the owners of the business, which is called the shareholders. All right, so remember, the blue is what you owe to the owners, the red is what you owe to outside parties, the green, the assets, is what you own, what the entity owns. So the business owns just over 4 million cash and they technically owe all of that money to the shareholders. All right, so that is it. Lastly, I can just quickly show you the notes to the financial statements. This will be the ordinary share capital note that you'll have in your notes, and it's for the year ended on 30 June 2014. So we can put here 30 June 2014, and we can have that in there. And then our note has got two parts, basically, the authorized shares and the issued shares. So how many shares was this company authorized to issue? Well, 1.5. They could issue up to 1.5, so we're going to have a little note explaining that. Number of authorized ordinary shares is 1.5 million. Good. Then our issued shares. Now there's various lines that you can have here in the notes. You can either issue new shares during the year or you can buy back shares. We're still going to get to that later. And you can have a starting balance on the issued share capital as well. So normally you'll have a starting balance. Since this is our first year of issuing the shares, there's no starting balance at the beginning of the year. But during the year, we actually issued some shares. So we issued 900,000 additional shares at a price of 4.50. So that then gives me a total amount in the current year column. Remember, this refers to your current year, which is 2014, and this refers to your previous year. We call that comparative figures. So in the current year, we're going to include our total amount, calculation 1, which is 4.05. Then if you had a share buyback, you would also include the detail of that. Ordinary shares repurchased. We're not going to go into that now. We'll get to an example later. And then finally, you'll be left with your total ordinary shares in issue at the end of the year. We only have 900,000 shares in issue, and that gives me a total of 4.05 million shares that is actually in issue.